if the venture capital thinks it's worth 10 million, but you only paid 5, you just doubled your money on paper, which is called the cap. There's also something called a discount to the round. And that's in case, what if you were right? It really wasn't worth $5 million. It was only really worth $2 million. And the company's going along and now they're almost bankrupt, but there's still something there. And some VC or another angel investor says, look, I'm only going to willing to pay you 2. Now, I officially agree that it could be worth up to $5 million, but if it's worth less than $5 million, say it's worth $2 million, I get a 20% discount. So I will get the common stock at a valuation of $2 million times a 20% discount of $1.6 million. So I will get common stock at the rate of $1.6 million. The next guy who's put money in, he'll get it at $2 million. The upside is the cap. The new round is higher, and the downside protection is this discount.
Today, we are going to be deviating from standard real estate. In a way, it's reminiscent of maybe if you guys were the earlier listeners in 2016, if you guys recall, maybe from 2016 to 2018 on this very podcast, I talked a lot about buying turnkey rentals. And that was what I did from 2012 to 2015. So as you guys know, the last 4, 5, 6 years, the topic material went to more accredited investor syndications and private placements. And a lot of this has been formulated in the new book, The Wealth Elevator, in the second floor of The Wealth Elevator. Now, to frame it the right way, today's topic is going to be an intro into angel investing, which is where you start to get to on the third floor of The Wealth Elevator and the penthouse level. I think a lot of people ask, how did you navigate this world? Right. First of all, my first 15 deals as an investor LP, I probably stepped on a few landmines there working with the wrong people. Hopefully what we try to create is the community of peers and good people and where you get a lot of referrals. Cliff's guest on today, and he's one of the guys I've been around for quite a while, and I thus trust him, right? So I'm going to go to him for investing advice, especially in worlds that I'm not around. For example, people are like, you got a lot of apartment investing people around, right? And some of these people may invest in mobile home parks, stuff you may not know about, but you build the relationship. And that's why the relationship is so important to take it to other things. Cliff, thanks for jumping on today. Really appreciate it. We're going to try and dumb things down for people a little bit, have this be a little bit of an intro to angel investing. Maybe let's start off like, what's your definition of it? And we'll go from there.
Yeah, we do it for the chicks.
Even though there's a lot of dudes at these meetings, right?
So the basic definition of angel investing is people who are interested in helping out young entrepreneurs with their businesses. And that can be anything from a restaurant to a super high-tech firm or a medical thing working on cancer. The range can be quite large. Often, many people will specialize in something that they have experience in for a variety of reasons. Primarily here in Hawaii, we frankly don't see that many entrepreneurs. We don't do that many entrepreneurial deals. But if I was in Silicon Valley, I probably would be doing either computer games or semiconductors, which is my background in Silicon Valley. But I get to see a wider range. And also for me, that included at some point real estate, because I started off with stocks. And then I, very much like you, I was an engineer. And then I achieved critical mass or fire and started with stocks. And then around 2009, I went, oh, wow, stocks aren't always all that safe. And I started diversifying into real estate. And then I really had accumulated sufficient that I was concerned that I needed maybe another pillar. And I looked at the Yale guys and other very prominent endowment firms, and they have a significant amount of their investments in non-traditional stuff. I think last I looked, Yale has 7.5% of their money in the U.S. stock market and 20-something% in venture capital, to give you an example. And it has a low correlation with other investments, both stock and real estate. And so if something happens to the stock market, we all get hacked or God knows what, all kinds of things. I want to have another piece of a portfolio that was negatively correlated or at least low correlated. And more importantly for me, I'm a little worried that hackers are getting better and better. And one day I may wake up and all my money at Schwab is gone. I think I may eventually get it back, but there could be a very long period of time. Ransomware, all that stuff makes me concerned about that. So that's the impetus for doing it. The second reason I do angel investing is I find it really educational and it's fun. We learn about companies. I learn about things from ice cream to X-ray used to cure cancer to various medical devices to all kinds of cool social media apps. And here in Hawaii, we've got a lot of tourism tech apps. So it's a wide variety of stuff, and it keeps me young, meeting younger people with cool ideas. And then also here in Hawaii, particularly for me, I like to give back. And in Hawaii, have such a limited range for our kids of opportunities. They can basically do tourism or banking and so forth. So I would love to
Right.
see a community like we had back in Silicon Valley where people could stay here in Hawaii to get school, buy a house, and not have to move to the mainland for 20 years in order to make a successful thing. So that's the reasons for it.
Yeah. I don't know if you remember this conversation back at the East West conference in 2019. I think you and I were talking, and I think what motivates you as an investor is like the betterment of society, environmental stuff we were talking. And I'll be honest, at that time, maybe even probably now, I'm more after the returns and cool stuff. But like you said, that changes for people as they mature, they get past financial independence and got too much money and just want to do good out there is part of
Yeah, but don't get me wrong. I don't go do this as a charity. If I was going to do this as a charity, I'd be giving something else. But because, quite frankly, the returns have not been awesome, this is not something you want to do. The returns on this are so crazily built on one side. For instance, if you had invested $1 million in NVIDIA in 1992, you'd be worth about 300 or 400 billion today. That's a mere 4,000%, 400,000% return, which is really good, but it's also the best return I think anybody has ever had in not the history of humanity, certainly in the last 20 years. So those returns are what excite people, and they should. The flip side is that most startups will fail and your return will go to zero. And that's, you get a tax benefit. And when I started off in angel investment, the state of Hawaii had a very lucrative program where every dollar you invested in a startup, you could deduct off your state taxes. So I was like, hey, I can give $25,000 to this cool thing, or I can pay that money to the state of Hawaii. Gee, that was not a hard decision when I had those choices. That program no longer exists, but the outsized returns, I certainly do dream of one of these companies letting me buy a jet. In fact, I kid several of the entrepreneurs say, you're the one that's going to let me buy a jet because I've always wanted a Gulfstream. I'm not completely serious on that.
I think you touched upon it, like angel investing. That's why I put it on the third floor of the wealth elevator and above. Go out, go have a career, make some money, maybe put it into, I'm just speaking from experience, right? I'm not saying this is the right way to do it, but that's what got me to the show here, right? Was real estate and tax benefits. But however you guys want to do it out there, we are all just data points. I'm not telling anybody what to do. There's not financial education. I'm just telling my story here, folks. But to me, angel investing very asymmetric is the term. When you've got money to lose, that's how you grow it even more. Let's get into angel investing. Like you hear about seed, pre-seed, total revenue. Maybe break down this timeline.
Well, and just for your listeners who haven't done it, if Shark Tank, it's a TV show, but it's actually pretty darn close to what actually happens. We meet the things, the sharks decide if they're going to give money, and it depends on a lot of factors. But the basic, to answer your specific question, companies, when they're very early, are what we call pre-seed. They typically don't have revenue. They have an idea. Maybe they've got a software guy who's written a little app that can show, I want to make a really cool program that lets you find a specific one that we have here in Hawaii. They said, you know what, people don't always know what kind of food. They have a specific, say they like ahi steaks. And they're looking for great places at ahi. They don't really care what kind of restaurant it has because a steak place could have ahi, a poke place could have it. And so they're trying to build an app that lets people find dishes as opposed to restaurants. So they build up an app and they don't have any revenue yet, but they've got an idea how they're going to get that. And they'll approach somebody and say, we need a few $1,000s to finish the app and another $20,000 to find some restaurants and another $50,000 to market the app and buy Facebook ads or Instagram ads or whatever. And so they're looking for a small amount of money just to get proof of concept. And that's what's called the
pre-seed round, usually 10 grand to $250,000.
Yes, 25 to $250,000. It's higher in Silicon Valley. You can pretty much every number I'm going to show would be about double in Silicon Valley or triple because it's more of a way of life in Silicon Valley and there's more money there frankly. But yeah, somewhere in the $25,000 to $250,000 range is a good thing for a pre-seed. And again, they can have zero revenue. Generally, what I have found is that ideas are not nearly as valuable as people think they are. It's all about the execution. I want to buy a apartment building and I'm going to increase the rents and I'm going to make the vacancies better, and then I'm going to flip it. That's the idea. But that isn't worth all that much. It's when you've gotten through all the steps that you do, then it starts becoming valuable. But the idea itself, not so valuable.
I think we talk about real estate most of the times, and I think we're going to be branching out here in the future podcast episodes, folks. But if you guys have checked out the YouTube channel, I made a video about this analogy called the horse versus the jockey. So in this analogy, take real estate, for example. The jockey is the operator and the horse is the asset that's going to carry you to victory. And of course, in this YouTube video, I have another couple other nuances, such as the stablemates and the track, which represents the market. But in this two-part simple analogy, the horse and the jockey, in real estate, the asset or the horse is way more important than the jockey. And I call myself out, like, it's not that hard to run freaking real estate. It's one of the time-tested things. It's not like breathtaking different, but in like how Cliff is saying, in the angel world or business operation world, roles and importance are completely reversed. And you can almost have a stupid idea, but if you have an operator to get you there, then it means way more.
I don't know if the execution is, I don't know what number, 80%, 70%, something like that. And the idea is 10 or 20%. And unfortunately, one of the issues that comes up, especially with young entrepreneurs or not so much young, new entrepreneurs, is that they put a lot more value on the idea and a lot less on the actual operation and the execution. And that's probably true with angel investors too, right? It takes a while. You need to get to maybe Warren Buffett's age at 50 or 60 before you get excited about a brick manufacturer, buying a brick manufacturer that has a really amazing process that makes the bricks 25% cheaper. But that's what he did when he bought them. But it's hard for people to get excited about it. I invested $50,000 in a brick maker. Doesn't sound nearly as cool as I invested $50,000 in the next cool video game or the next thing that's going to cure cancer. So that's one of the early pitfalls, I think, that many angel investors, when they're first starting out, they get too excited about the idea and less about the entrepreneur and the execution.
And something I key on, maybe I just come from the world of real estate where relationships is key. Part of the execution is your network and the ability to navigate social connections. Just for marketing or a lot of these deals we've been seeing lately, it's about getting these new products sold B2B in these companies. So you got to have the sales and you got to have doorkeepers open. You would think that an older entrepreneur, experienced entrepreneur would do a lot better. At the same time, who the hell wants to do this once you've got a few $1 million net worth, right? You become on the passive side as an angel, right?
Entrepreneurs I'm lazy. That's fundamentally why I've not tried to do these things. There are serial entrepreneurs that it's not about the money. It's just about making this idea and growing it and becoming a business. And it's hard to generalize about them because sometimes they're just amazingly successful. Other times they're a little crazy. You need to be a little crazy to be a good entrepreneur. But yeah, growing the business there are definitely people who just cannot think of being passive. They want to always be active. And sometimes some of the entrepreneurs I see that have they've had an exit where they've made $5 or $10 or $20 million. And then they become an angel investor and they get a little bored, frankly, because they don't have the level of control that they want, because they really like the idea and they want to help the entrepreneur. And the entrepreneur doesn't always necessarily want their help. Sometimes they'll take their input, but they don't necessarily want to have them run the company. That's their job, is to run the company. So that's another kind of strange situation. Yeah. So after seed, their pre-seed, then their seed. This is, I said, $100,000-ish to maybe $1 million. Again, those numbers are pretty flexible, but that's the right range of revenue. And then they are raising from about 200,000 to 2 million. Again, these are very large ranges, and that's partly because there's no defined numbers on these things. It's word of mouth. And what's going to happen in Hawaii is going to be slightly different and lower than it would be in Silicon Valley. The seed round is the end of the road for angels, meaning that beyond this, once you raise more money than that, we'll get to the VCs. Angels just are not an important part of the system. A typical angel investment from $10,000 on the low end, $1 million on the very high end, but really realistically 100,000 at the top of it. There's some very rich people who will throw in $250,000 or $500,000 or $1 million like they did in the case of NVIDIA. Generally, it's in the $10,000 to $100,000 range. If you can imagine, if you were raising $2 million, 25, that's 40, 80 different people you need to work with to get 2 million. Or if they're even 100,000, that's 20. That's where you typically go to a VC. And a VCs will start at as low as $250,000 or $500,000, all the way up to 100 million. And that would be the A round, which is the first institutional round where there's a venture capitalist who will give you substantial amount of money. Again, almost always in the few $1,000,000 range up to the $10 million range. And they in turn will demand something that angels typically don't get, but would be nice if occasionally did. And that is a seat on the board. So they will actually have a say in the direction of the company. A 3 or 4 man board. A VC will typically take that first seat on the outside director in the company.
Just to back things up, because I'm learning this too. So part of this is if the company's making revenue, right, may or may not be profitable yet, likely not profitable. But if they're not making any revenue yet or insignificant revenue, is that constitute a pre-seed, or is it not really, is it detached from the revenue?
No revenue is almost always pre-seed. Minimum revenue, as they say, 100,000-ish a year is a seed. It can be as high as a few $1,000,000 and still be considered a seed. There's obviously an overlap, but once you get into the few $1,000,000 a year in revenue, typically that's when you would be raising an A round with an institutional investor. I know these ranges are quite wide because there's a lot of overlap, frankly, and there's no book that sort of says this is what it is. So what was currently considered a pre-seed round, a seed round is now a pre-seed, and a Series A is a seed. As more and more money is raised, the bars have changed for each one of these rounds of financing.
Which makes it tough for investors, right? Because there's no simple rubric. What's a Class A building? What's a Class C building? It can also be like number of employees too, might be somewhat of an indicator. And then I don't know if you're in that last deal we're looking at, but it was just like the guy just did it all by himself. And it was pretty much, hello world, I'm already seed round already because I'm already making a pretty good revenue at this point. And then just to reiterate what Cliff said earlier, I think, I don't know how much people have in their wallets out there, but it seems very similar to our investor group. Like most of the investors that are angels are like us, where we are categorized as retail investors, regular people with under $10 million net worth. Crazy that number is regular people. But once you get over to the A rounds and venture capital firms come in, that's when little regular people like you and me, we're out, right? That's it at that point.
Yeah.
I would probably equate it to in real estate. And sometimes when you're looking at debt deals, you have different grades of paper, A, B, and triple A. Sometimes when people are lending money with house flippers who have done jack in their life, but they are going to another capital company, they may pay 15, 20% returns to the investor, but that's seen as very bad paper, very like C, maybe even D paper.
Yeah.
The people investing in those deals are typically individual investors, maybe the friends, family, and fools round, I call them. But if you can spot out the fakes from the real ones, that's where you make great asymmetric returns. And that's essentially where the risk and the reward comes from in this world.
Yeah. And I do some of that. I do a fair amount of high risk equity lending, both to real estate and occasionally to companies that I typically will get between 15 and 20%. And guess what? They don't all pay off. Most of them do, but certainly not all. And in typically for me, those generally have worked out pretty well, not always, but that's also another sort of form of angel investing. It doesn't have to be equity. It can be debt or a combination. The classic one that I did is I invested both at an equity level and then at this royalty level, a company that shipped beachwear, slippers and suntan lotion and board shorts and that stuff. You got one a month and they charge $100. I got $1.50 out of every one of their shipped until I doubled my money and then I had some additional upside with them.
Yeah. So that's more categorized as like debt or business financing.
That's called revenue-based royalty. Right. Kevin O'Leary on Shark Tank calls it a royalty deal. And that's basically the same thing. Yeah.
Yeah. Which is from a general partners normally like to give out common equity because if the investment doesn't pan out, then nobody got paid, right? But
Right.
in your respect, what Cliff is doing in that situation for that part of his portfolio is what he's taking his investment and in a way hedging himself, but he has more of a surety of payment at the
Yeah.
end.
And in theory, there's generally some level of collateral inventory or something like that, but it's not like real estate where you got 80% loan to value or something like that. It's closer to, you get 40 cents on the dollar. So that's caps your downside. You can definitely still lose money on it. And obviously, if they screw up their operations, they can go bankrupt and you can get nothing. All that tends to be rare. You generally get some return. Whereas opposed to the equity, if the company goes over, goes under, you're gone. I mean, they almost never get any money back.
We went over the timelines a little bit in the stages. So like in real estate, we have like, or if you're common equity, there's usually some type of waterfall structure. But just to make it real simple, a lot of deals, they have this equity split where say the passive investors get percent of the returns and the general partners get 30%. And the thing about real estate, most times there's just one entry point, right? So maybe talk to me about in a pre-seed or seed, like you have people enter in and they have these safe rounds. Like, what are these safes? And like, how did the splits, like maybe equate it so people understand like splits in real estate deals, maybe if it's a little bit different.
One of the easiest ways to invest in angel investing is to join a venture capital firm. And there's a zillion out there, and they typically have the same kind of split that you do. The standard split for a VC firm, and then you're going to be investing in, depending on the fund, somewhere between 20 and 100 companies. A lot more diversification. The downside is you will typically pay 2% and 20, which means that if the fund raises 100, call it 50 million for ease, that means they're going to get 2% of the 50 million or $1 million a year as to pay for the VCs and the analysts and frankly their salaries. And then they get 20% of the carry. So if the VC fund starts off $50 million and they return 100 million to investments, the $50 million of profit that the limited partners would get, the VCs would get 20% of that 50 million or $10 million. So it's very similar to the real estate thing. But in the same way that I have bought individual properties and put up with the hassles of finding property management, blah, 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 you can do that by individually investing in the company. So that's an alternative way of getting
into venture capital. But through ideally you're going through their professional varying levels of due diligence. And if things were to go wrong, they're supposed to step up in your behalf and get the lawyers and do that type of dirty work for you. Some investors, they're like, oh, I'd be damned if somebody take 2% from me or 20% of the carried interest. And I'm like, all right, cool, man. Do it yourself. Go build your house on your own. That's what we do, right?
I have done both. For me, the psychic benefits, the educational giving back is significantly less than giving the money to a VC than doing it myself. I miss the one-on-one expenditure with the entrepreneurs. And frankly, VCs aren't necessarily a lot smarter than me when it comes to this stuff. Many of them are, but how many of them were smarter versus how many were lucky is a completely different story. And I don't know what the answer is. Like many things in life, it's always better to be lucky than good. And that for me is part of the reason I'm not gung-ho on VCs, but they are on the 2 and 20 because a lot of times they don't make money and they get their 2%, which depending on how big a fund they raise, isn't always that much money.
Yeah.
There are a lot of very small VC firms that only raise $10 million, like the ones here in Hawaii are that size. So that's $200,000. If you've got 3 people working on it, that's not an extravagant lifestyle.
Let me know when you want to make a VC firm, Cliff. We'll work a deal.
We do have one, Hawaii Angels, with the blue startups. They will take your money and distribute it to all the various blue startup companies. And they do get their 2 and 20% carrier, but it's actually has some interesting benefits. So that's one way of participating in the Hawaii world.
I'd say like most of our investor base, 90% is non-Hawaii.
90%, okay.
But they're always looking for an excuse to come to Hawaii and write stuff. But so out of the Hawaii Angel group, majority of people are just individual angels sitting at those tables.
Yeah, we do have several VCs, which is a brand fairly recent thing, last only couple of years. We have several local VCs who do invest in both Hawaii companies and they look at Asia too. I get 4 right now. That's a kind of a cool new addition because occasionally they are interested in the companies we're in an angel investment. So we had one of the early ones we had this year. the VC spent a lot of money to bring in a code guy to evaluate this guy's AI technology and so forth. And we got to leverage off of his due diligence, which was pretty exciting. And of course, he invested a big chunk of money, but I felt much better as an angel investor having to co-invest with this guy, not having to pay the 20%. I was like, oh, this is a win, and a very good company too.
I call it the proximus. When you're at an intersection in your car and the big truck is making that left turn. If he's going, I'm just going to use him to scream
Oh,
me
yeah,
to my right,
exactly.
right?
Yeah, it's
Like,
going to
not
hit it.
investment advice out there, folks, but hey, these are just the practical things that you learn.
Oh.
Let's get back to the safe, right? Tell us about the.
All right, brief history. The general problem that entrepreneurs have, and it's significantly different than real estate, is there's a very huge difference between ask and bid. And how there's a tiny spread on ask and bid in the stock market, and there's a fairly moderate one. The $3 million apartment, they might want to ask 3.2 and you're only willing to pay 3, and you guys split the difference at 3.1. That's standardish in the real estate market, or there's a 10% or 20% difference between what you think it's worth and what they think it's worth.
It's a very liquid market. We know what the prices are. Yeah.
In angel investing, it's not uncommon that I think your company is worth $1 million and you think it's 10, right? Wow. And that's a big deal. And they on a Shark Tank all the time, actually, but it's very common that there's that huge of a difference between what I think it is and what you think it is. So in order to basically punt on that valuation of what's it worth, $1 million or 10 million, they've come up with a couple of different programs. The most common one is the SAFE, stands for Simple Access to Future Equity. And what it is it says, okay, we can't really agree on the price. But what we're going to do is when you go out for your next round, for your A round, when you do institutional, when you get to talk to that VC, they will bring in valuation specialists and they'll come back with comparables and very much like real estate appraisal. We think it's worth X number because that one was worth Y, and they'll figure it out, and then they will negotiate with the entrepreneur. Now that takes a significant amount of time, legal fees, and time for the entrepreneur, and legal fees for the VC to do all that work. So at our little stage, when we're writing $10,000 or $25,000 checks, and the entrepreneur is trying to raise $200,000 at a pre-seed level or even early seed, it's just not worth the time. So we're going to punt on this, and we're going to defer that discussion of valuation to a future date. So what they do agree on is we say, okay, we don't know what the actual value is, but we will agree to you that the cap, meaning the most we will charge you, is $5 million. If it gets to be $10 million for the next round, you got a deal, or maybe you didn't get a deal, but it grew into its valuation. And if the venture capital thinks it's worth 10 million, but you only paid 5, but you just doubled your money on paper. And so you'll agree to that term, which is called the cap. There's also something called a discount to the round. And that's in case, what if you were right? It really wasn't worth $5 million. It was only really worth $2 million. And the company's going along, and now they're almost bankrupt, but there's still something there. And some VC or another angel investor says, look, I'm only going to willing to pay you 2. Now, I officially agree that it could be worth up to $5 million, but if it's worth less than $5 million, let's say it's worth $2 million, I get a 20% discount. So I will get the common stock at a valuation of $2 million times a 20% discount of $1.6 million. So I will get common stock at the rate of $1.6 million. The next guy who's put money in, he'll get it at $2 million. The upside is the cap. The new round is higher, which is most of the time. And the downside protection is this discount. That's the common reason we have safes. There's a standard form. We don't pay any legal fees on it. There's minor variations. Each accelerator has their own, and there's 5 or 6 out in the market, and they're all very similar. You don't really need to worry about one or the other. And you don't have to spend any time reading the 7 pages of legalese, right? They range between 3 pages and 6.
Yeah,
but you don't have to worry about it.
They're really very short documents.
So the things you mentioned, the cap and the top
The
number,
discount.
those determined in the safe, or
that is, that's what the entrepreneur will say. I'm raising $500,000. The company we saw last week is raising $300,000 at a $6.4 million valuation. So basically just under 5%. He's giving them just under 5% of the company. After he's raised his $300,000, the total value of the company will be $6.4 million. If in a year, or actually in 6 months as he hopes, he's going to have a lot more sales. He hopes to have $100,000 a month or $1.2 million a year of sales in the next 4 or 5 months. And then he'll go out, he'll raise a lot more money, maybe $1 million or $2 million at a $10 million valuation. And so I'll get basically a 50% bump in my valuation in that 3 or 4 month period if everything goes as planned. So I got my money at $6.4 million, the maximum. The next round is at 10. So that's roughly a 50% increase. Now, the one caveat on all this stuff is the early investors don't typically get any liquidity until an A round or a B round. So once the company is raised, they'll throw out a number here, not always true, roughly 50 million or 100 million. At that point, the very first investors can get some, but not all of their money back. Generally, you can get, if you put in $25,000 and it's gone through several rounds, you'll get $50,000 in cash and you'll still have 80% of your equity. They'll cash you out at 20%, and you'll still have 80% of your things. You made your money, you're playing on house money at this point. If it goes to the moon, you can get even better. But before then, you are still stuck. You have a paper increase because the first seed level was at 6.4 and the bridge round was at 10 million, and then Series A's was at 20. All of those will increase your wealth on paper, but you won't necessarily see the cash until quite a bit later.
So maybe if I missed it earlier. So that established pricing, right? The valuation, is that kind of just the entrepreneur puts that on the safe agreement and then just puts it out there, and the investor's a F you, this isn't good.
Yep.
Then he has to scratch it out and maybe do another number. Is that kind of the game?
Yep, pretty much the game.
So at that point, there's no like official appraisal involved in this process. How does this normally play out? Because you got a guy who just throws a stupid number evaluation out there, and then what if the angels don't know?
They don't get funded. So our pipeline in Hawaii Angels is worth looking at. Typically, we screen 4 or 5 companies a week. Actually, take it back. I'm going to start back. There's a online application process for Hawaii Angels in the neighborhood of 20 people, very briefly, because a lot of them we know they're crap. They're just one step up from the Nigerian scammers and such, right?
They're calling you too? I don't know. Those guys
they're everywhere. But we'll seriously look at 4 or 5 a week, 2 of which will present. And of those 2 that present, typically one, I'd say out of 10, probably 4 will get any kind of funding. That's that screen 4, I would say maybe 20% will get funded of the ones we're seriously about screening. And they will get generally between $75,000 and $200,000 from our average size group. And they can go to other angel groups and raise more, but we're very much an average group in the country.
So the safe agreement that the Hawaii folks do may be different than the Boston.
No, it's going to be almost virtually identical for the one that's Band of Angels in Silicon Valley or the New York Angels or any of the others. They're pretty much interchangeable. So that's the good news, is that the standardization of this process has made it much easier for, if you raised a pre-seed in New York and then you move to Hawaii, you're doing your seed, we can look at that safe and go, okay, we understand what that is. It's higher now because your company's made some progress or whatever. So they're pretty standardized.
Okay. So as a passive investor, you can see what the other safes that got leveled to this point.
One of the things that you go through as you look at the companies is you ask to see their cap table, and they should have a list of saying, okay, Joe and I, we're partners. We own 35% of the company each. My dad, who put in $100,000 in the beginning, he gets 10%, and we're now selling out the remaining 20% to you angel investors, or we're going to sell 10%. So we have 70, dad has 10. We're going to give another 10% to people in this round, and then we're going to give another 10% to the people in the next round. Okay, so now we have given up. So at, say, the end of your seed round, dad has 10%. We each have 35. The pre-seed people have 10%, and the seed people have 10%. Now what happens at Series A? With Series A, what happens is the entrepreneurs typically will give up some of their own equity. So they'll say, okay, we're going to go down from owning 35% of the company, 25 each, and you, the VCs, are going to get 20% of the company, but you're in turn going to give us, say, $4 million. The entrepreneur will actually get that money. at that point, because the entrepreneur will be getting some of that money. The company will get some, the entrepreneur will get some. If how entrepreneurs get money out of this situation.
And maybe if I track that, the entrepreneurs portion of it, they come to Hawaii, get some under $1 million there. They still have 90% of the equity, right?
Yeah.
Right at that point, plus or minus 10%, right? But once they move to that A round and then they get paid themselves, right? They cash out themselves at
They
that
can,
point.
they often are allowed to cash out a decent chunk
Yeah.
of it at that point. Yeah.
What
Because often they're not paying themselves very minimal amount. The last Hawaii guy you saw, I think he's paying himself $3,000 a month. As you well know, that's not enough to live well in Hawaii. And so he's burning through a little bit of savings and he's paying himself a pretty small amount of money. Yeah. At that point, they can stop eating ramen all day and graduate to actually having a steak once in a while.
So at that point, an entrepreneur might have 90%, and then maybe he gets paid a few $1 million to get cashed out, and then the ownership percentage goes to what then normally?
I generally want to see at least two and three. So as a team, the entrepreneur, the team, so the CEO, the CTO, and maybe the chief marketing guy, they collectively will own 50% at that point, 60%, something like that, after they've gone through a VC round. By the time you get to when Elon Musk goes public, they typically go public, even in very successful ones, with around 20 to 30%. I think that's what Bezos went when he went with Amazon. The majority of the company is owned by investors and the founder has a minority shareholder.
Let's take out those outliers, right? I can't stand it hearing about Elon Musk, and let's talk about 99% of the other successful entrepreneurs out there. What do they normally exit at? What's their FU number that they're shooting for sometimes?
Man, that's a good question. I know a moderate number of folks who have exited, and some of them are Hawaii Angels, some of them are Axels. They generally will exit between 20 and 100 million.
But they got to split that in their team though.
No, yeah, you're right. Yes, in their team. So CEO has half and everybody else has the other half. Well, that's pretty typical. So maybe the number's closer to 10 to 50. It's a good payday for quite a few of them.
You don't have to do it again.
Yeah, well, I would say more than half the time, the guys who do exit come back. Now, there are plenty of guys who do make much smaller exits. They'll come away with $1 million. So it's a nice chunk of change, but it's certainly not FU money, certainly not here in Hawaii. So they have to go back and either work at a company. Often their exits will be, we're going to take you over. We're going to give you a good contract. We're going to pay you $250,000. We need you to run your company for 2 more years, and then you're free to go. Or maybe they'll give them stock options and so forth. So that's probably the most typical for entrepreneurs is they get bought by a larger company. They get a nice salary bump and some stock options. In those cases, the investors get our money back. Maybe we get 2x, sometimes 3x, but it's not an overly exciting return, frankly. But those are successful exits, but they're not enough. They're like real estate or even lower than real estate.
After the venture capital comes in, that's when it goes to the investment bankers after that.
Series A generally is a C, a B, C, and D. And I think with the last I saw, by the time you get to E, you start to do an IPO. Well before then, they get acquired by company. The funnel is IPO is really small percentage. Acquisition by a company is fairly large. Bankruptcy is the largest. And something in between of a really big acquisition to an okay acquisition is probably 20% of the company, something in that neighborhood.
Maybe to end with something fun here. I don't know soccer very well. I don't know if you follow soccer.
Not much, but
you know when you want to sound cool in front of your other soccer friends, you don't know what the hell you're talking about, and you're like offsides, right? Could you say an angel investing would be like something that you key in on? And I could just say that to make myself sound as smart as you.
Oh, wow. Man, that's an interesting question. I've never had that question before. Here's one that would get my interest. Oh, wow. I negotiated X liquidation preference with this last thing. That would make you sound smart.
Okay. And if I'm understanding that right, correct me if I'm wrong, that means that as an early investor, I get to get out sooner rather than later in a way? Or
it means if a company basically goes under or gets acquired, you get 3 times what you put in before the regular common stockholders get anything.
I've been on the equity in real estate, right?
It's like pref equity in real estate. Exactly correct.
Or to dumb it down for everybody more. It's like somebody, they went bankrupt and they got to have a big garage sale. You get to come in first and get
Yeah.
yours before
Yeah,
everybody
there
else
you go.
does.
Yeah, that would be the one. Yeah.
I wanted to give you the last say here. I know you're always looking for new investor buddies in the local
Yeah.
Hawaii group. Maybe just give us a quick rundown of the group. I would say it's a great kind of eclectic group of working professionals, ex-professionals, and entrepreneurs. I like it because I always see new things, especially on the marketing side and
Mhm.
ideas. But maybe what do you get out of it, and just maybe to entice people, and maybe if
You
they're
know,
interested.
the deals are cool. The networking is great. I have found a really awesome accountant, good estate lawyers, some good buddies, and a fair number of other deals. These guys are like you and me. We like to try our deals, and sometimes they got some pretty cool ones. I'll say, hey, Cliff, I've got this cool deal here. You want to invest in it? They've been more consistently profitable. And there's some really the smartest and richest, which I think are highly correlated guy there, was in charge of Citibank Asia. Then he started a telecom firm at Sri Lanka. So he literally started the telecom company in Sri Lanka, sold that. And he now has started this crazy firm that's our most successful angel investment, which basically sets up a tax shelter for Japanese companies in the Federated States of Micronesia. He managed to convince he rewrote the legislation for this company. They literally have like statues for this guy that are erected because he's made such a huge difference for this little tiny Micronesian nation. And now this company has tin mines in Australia, and he's just a really cool guy. And he's very kind of low key, and you wouldn't expect it, but he's a really high powered character. And then the Tetris connection is cool. I think we all grew up in Tetris, but the guy, Hank Rogers, who's had a movie about here, he's part of the Hawaii Angels, and his daughters, they're often. So there's some very cool players in there. And we also have a great jet fighter pilot who still is just had to lose his pilot's license at age like 85 or something like that. But he also is a character. So there are a lot of interesting characters.
I think it's a little bit older group, right? Because it's a little more passive.
You're helping the age, my friend. I'm glad you joined. And we've gotten a fair number of people in the 30s, 40s, and 50s. But yeah, most people do have gray hair. We're trending downwards on our age graphs.
Young at heart, though, open-minded and young at heart.
Oh,
yeah. It's out there that I'm in, like Vistage, EO personally. There's YPO. Those three are a little bit more operator, entrepreneurial types. But I think the saying is you got to find your tribe out there, and oftentimes you got to pay to play. But yeah, thanks for jumping on, Cliff.
Thank you. It was fun.
Yeah, I don't know if you want to put your contact information out there, but if you guys want to reach out.
Anybody's here in Hawaii or has a part-time rental, they're here part-time, shoot me an email and I'll be happy to interact and make you a guest, and a pretty good meal at one of our nicer places in Hawaii. Can't turn that down.
Yeah. Thanks, folks. Again, I think what you're going to start to see in the future is a little bit more rounded out. Like personally, I think from 2012 to 2022, my portfolio was majority real estate, 80-90%. Nowadays, I think a larger chunk is becoming more life insurance for me, but I'm trying to build this little sliver of a pie for more asymmetric types of deals like this, whether buying businesses that are already producing revenue or total non-revenue angel deals. But I'm just trying to get more rounded as an investor myself. But thanks all for coming. We'll see you guys next time.